When you first start out on your trading journey, there is no doubt that a very common term you're going to hear is the words support and resistance. Support and resistance are very, very commonly used terms, and they basically refer to what can sometimes be called a floor, where price tends to hit a certain level to the downside quite often, and it doesn't break lower than that for a period of time. And then resistance would be referred to as the ceiling, where price pushes up against it, and every time it attempts that level, it tends to hold that level until eventually it breaks it. But there is a really big problem with support and resistance, and I'm going to go through that in this video with you today, and I'm going to give you an alternative. I'm going to show you some other horizontal levels that make absolutely so much more sense for you to consider when you're learning to trade, as opposed to support and resistance. So if you are on your trading journey and you are wanting to learn to become the best trader that you can be sure to hit that subscribe button down below if you haven't already subscribed to this channel, and also hit like so that we can get this video around the internet as fast as possible. Now let's get into exactly what I'm talking about here. Now, before I show you some key levels that, as I said, I feel are more important than support and resistance, let me just go through some common issues with support and resistance itself. When you're drawing a support and resistance, you're basically just looking for somewhere to draw a horizontal line that you believe price has pushed up to a number of times. And when it comes to drawing the support, same thing, but to the downside, where you believe price has hit a number of times. Now, here's the issue with this. Number one, because support and resistance is so common, it becomes a very, very common basic target for the market makers to issue stop hunts. Just like what you're seeing here, this wick to the upside at the time that candle opened would have been a very, very fast move to the upside, knowing that people who trade support and resistance would have opened shorts at the multiple rejections of this resistance here. They would have had their stop loss just above the resistance. And you can see here that even though their trade would have played out, it didn't play out before the market maker stopped you out of that trade. And the same thing happens the other way. If prior to this price action, you had drawn your support, say around here, you may have opened a long position believing that price was holding support, had your stop loss just under the support. And again, if you held on to that trade and didn't take profit, market maker eventually stopped you out before moving in the right direction. The second issue that I find with support and resistance is it's very, very subjective. It's an opinion on where you believe a level should go. Whilst you're learning to trade, it's going to be very, very common that you don't trust your own opinions. It's all part of the trading journey. So whilst I personally have placed my resistance line here, you may make the rule that you only place resistance lines to wicks. So who's right? And sometimes this can lead to whether or not you end up getting stopped out in a stop hunt move. So when it comes to trading, for me personally, this is the one thing I try to remove as much of. When I'm looking at charts, I want fact-based data. I don't want to have to put my own opinion on the chart. I don't want to have to decide if this is the right level for me to put it at. This is where I find a lot of the common ways of trading that we're all taught when we first learn to trade are very, very subjective. And when it's subjective, it's simply just a matter of opinion, and it can take you a really long time for your opinion to end up being right. So what can we use instead that is going to be more and more relevant? There are key levels that act as a magnet for price, and they are factually based levels. They don't come from an opinion of where I feel like they should be drawn or you feel like they should be drawn. It is an undeniable fact. So if we were to trade off the levels that I'm going to show you now, where I put my level would be exactly the same place that you put your level, because it is a strict rule. So let me go through them with you. The first levels that we're going to talk about that are very, very important is called the high and the low of the week. This happens when we take into account CME trading times. So you have to understand CME trading times are very different to normal trading times. A lot of the time, a lot of people trade off the daily open. That's got nothing to do with it in CME. So when we're talking about the high and the low of the week, we are wanting to know the absolute highest point the price went in a 1 week time frame from Sunday 5 p.m. to Sunday 5 p.m. always New York time. And if we're talking about the low of the week, It's the opposite. We're looking for the lowest point the price went from Sunday 5 p.m. New York to Sunday 5 p.m. New York. And the high and the low of the week always comes from the week prior to the week that you're currently trading. So if we have a look at this, this is a current week right here. This is Monday, Tuesday, Wednesday, Thursday. So that would mean that this area right here, the shaded area, right before where that shaded area starts, is Sunday 5 p.m. New York. So I want to go from there back to the prior Sunday 5 p.m. New York, which happens to be here. So I'm only interested in the price action from this area here, which is the most recent Sunday 5 p.m. to the Sunday 5 p.m. prior to that. And in this region, I'm looking for the absolute most highest point, and that does include the wick. So looking at only this price action, you can see here that this red wick right here was the highest point the price went. And so my line is automatically marked on my charts. This is a custom designed TTC indicator that I'm using, so I don't have to manually draw these levels myself, and no one in our TTC community who's on one of our membership systems, none of them have to manually draw this stuff themselves either. So if you are interested in using tools like this, as well as getting access to all of our education and get access to our community and also all of our live sessions, then consider joining a TTC membership. The link will be in the description of this video, but this is just one of our indicators that we use, and it automatically marks for us the high of the week, taking into account the exact dates I told you about. However, if you don't have that, it's a simple matter of finding 5 p.m. New York to 5 p.m. New York and then marking a horizontal line across the highest point the price went. Then we do the same to the bottom. So in the same period of time, you mark the lowest point the price went, which you can see is this wick right here. Now, the reason that those levels are very, very significant is because once a new week starts, one of those levels is going to act like a magnet. So price is going to be drawn to one of those levels, and then it's either going to hold the level and reject at that point, or it's going to break through. And if it does break through and then retest the level, that would give you the idea that we have a continuation of that trend. So to give you an example, moving into this week so far, we can see here that at this point, we broke the high of the week and we have consolidated above it for a few days now. So that would lead us to believe that at this point in time, we would be still bullish on this particular coin. Now, you can see that there were a couple of closes down here. How would you have assessed after this move whether or not to remain bullish or to flip bearish? What would need to have happened there would be a change in structure. So we would have needed to see after this, which was obviously a stop hunt, but after this, we would need to have seen some change in structure with lower lows and lower highs and a failure to get back above the high of the week. We've actually successfully come back above the high of the week, and we retested it again right here. So in this, you can see how significant that level is. Now, whilst you're learning all of these amazing levels that are going to make your trading that much better, consider joining up to BitGet as the exchange for you to place your trades on. BitGet is one of my favorite exchanges. They have spot trading, leverage trading, all of that kind of stuff. And at the moment, you can get a sign-up bonus. And if you use the link in the description of this video, you also get a 20% trading fee discount for life. Now, you can only get that with the link in the description of this video. And if you have a look down there as well, you'll also see that using the exchange links that are in the description of our videos also get you access to our free Discord, where we do share some market updates daily. And there is a community in there all learning to trade as well, so that you can have conversations with people that are on the same journey as you. Now, just like the high and the low of the week, there is also another level that you need to be very aware of, which is called the high and the low of the day. When the high and low of the week relates to the prior week, the high and the low of the day relates to the prior day. So if I'm looking at this day, I can see here Monday, Tuesday, Wednesday, Thursday. So this is Thursday and this is my current open trading day. That means my high and low of the day is the highest and lowest point the price went on Wednesday. So the one day prior to the current day that I'm trading. So if we zoom in on that, and again, you can see that our indicator has marked these automatically, but you can see here that if this is the current day, This is the prior day, always still again 5 p.m. to 5 p.m. New York. So I'm looking for, in that period of time, the highest point the price went, which was this red candle here, the wick of this red candle. And you can see that that exactly matches up with the line that has been put across my current day. That is my high of the day. Exactly the same in reverse for the low of the day. I'm looking for the lowest point the price went on the day prior, and that is this wick right here, which exactly lines up with my line here, and that is marked as the low of the day. So the same thing will happen again. Price will get magnetized to one of those levels, and then it will act as either a support or a resistance. But why is it more important? Because it's a fact. It is a fact that that was the lowest point that the candle went that day. It's not my opinion. I didn't make it up. I didn't draw this line here, where if I was drawing support, I might say support is to candle closes and someone else might say it's to wicks. And it may not look like a big deal, but a little decision making like that you have to make on your own can be the difference between whether or not you get stopped out. So how does using these levels stop you from getting stopped out? Because when moves like this are made, let's use this stop hunt because it's a very good example. When moves like that are made, that was an intentional move to liquidate traders on this particular day. So that doesn't happen when you use levels like high and low of the week and high and low of the day, because after this move is made, we now know the highest point. That is designed to trap traders. So as long as you can identify who's trapped, you know where to properly place your stop loss. So as a trade example, if price were to return around this level and look weak, if it happened to get closer into this area and you wanted to open a short, your stop loss would go above where you know the last trapped traders were. And that's how you don't become a victim of the stop hunt game, knowing that these levels are created to trap traders into a position. So this is what makes those key levels so significant. Now, there's one more level that is really, really important, and that is called the initial high of the day. So don't get that one mixed up with high and low of the day. High and low of the day is related to the price from the day prior to the current day that you're trading. Initial high and low of the day is created in the Asia session, and some traders include the price action of the dead gap zone and some don't. That part is personal preference. At TTC, we do include the dead gap zone just because we found that one of those levels, whether it's the initial high or it's the initial low, one of those levels is usually formed in the dead gap zone. So we do include it. Now, the initial high and the low of the day, as I mentioned, it's formed in the Asia session, and it's usually formed with a hammer, and the role of Asia is just to consolidate, usually in no more than a 2% range. And they're consolidating because the UK's job is to run a trend. So once that consolidation has finished in Asia, UK will run the trend with the goal to break one of those levels. So if you can identify those levels, then you can identify which way UK is going to run the trend. So the initial high and the low of the day cannot really accurately be drawn out until Asia is finished, but it is formed usually with a hammer, and the hammer will create the lowest point of the Asia session, and an inverted hammer will create the highest point of the Asia session. So to show you again what that looks like, this here, the shaded area is the dead gap zone, and then this here is Asia up until this last turquoise dot. So we're only taking into account, when we're looking for the initial high and low of the day, we're only taking into account the price action up to this period of time. One other thing that you need to know about this is that Asia issues an extension usually at around 2 a.m. New York. So this is why on this indicator here, which is another TTC custom designed indicator, but this one down here is public. So you can add this to your chart if you want to. Just go to your trading view and type in market session times by Trade Travel Chill, and you'll find it there. And when you add that, you can play around with some settings, but it will give you the session times at the bottom of your chart. You don't need to change time zones or anything like that. It's always going to be set to New York time. Even if you make changes here, it won't affect anything. So the reason that we marked the last 4 candles in a different color on this is to let you know that this is the period of time that the extension usually forms. So the way that we've personally designed our indicator is we want to be very, very clear about when that extension is happening. I mean, if you just look at this price action, for example, you can see that price stayed in this zone for the whole of Asia today. And right on that turquoise box was where we got the breakout. So it's very, very predictable. Asia extension leads you into what the UK trend is going to be, but that's not what this video is about. Just letting you know that on our particular indicator, because we want to be able to clearly identify where we are expecting that extension, we actually stop our indicator marking the initial high and low of the day at 2 a.m. New York. And that is simply so that the extension really, really stands out to us if for some reason we weren't actually paying attention. So using just what you can see in this box here, let's have a look at where the initial high and the low of the day was formed. It's very, very clear to see that this was the candle with the wick in that section that gave us the highest wick in that period of time. So this right here forms the initial high of the day. To the downside, we do have this hammer here, but in this one, I'm actually going to say that the initial low of the day was really created here because you had the bullish engulfing and then we retested it and we held it. So usually it's a hammer, but in this case, I would say the bullish engulfing does count. Once that is created, you want to see a consolidation for somewhere up to 90 minutes, anywhere between 30 to 90 minutes. After that period of time is when you would consider it to be safe to trade if you wanted to trade Asia. From this candle that actually opened the dead gap zone to this candle here that retested it, you could see that that is 1 hour. That's 60 minutes. So holding that level for the entire 60 minutes would have had you believe that the initial low of the day was set. And if you were a short time frame scalper trading the Asia session, you would have been safe to put your stop loss just under the initial low of the day and wait for the initial high of the day to be in and take your profit. Even if you ended up closing this, you would identify that one to be the initial high of the day, followed by this bearish candle. You would take your profit somewhere in that bearish candle. It's a 3-to-1 risk to reward. As a day trade, that would have taken you 2.5 hours to get that return. Like, that's pretty amazing as a day trade. And it's quite predictable when Asia is running its typical behavior. So the time that you wouldn't execute on this is if Asia starts to run more than a 2% range. That means something else is happening today. You're being set up for something and you should just sit back and be patient. But if Asia is giving a 2% typical range, then there's no reason why you couldn't scalp that. And if you understood these levels, then again, we know that this is set here and it's not going to return lower than that because the initial low is already set for the day. That's why you know clearly where to put your stop loss. The same goes for the other way. So if you had to close that trade and then you saw this, you're confident that the initial high of the day is in. On the next candle after that confirmation, you also know now where to put your stop loss just above that wick because it's not going to return higher there. And you take your trade back down to the initial low of the day. That's another 2-to-1 risk to reward. That was clear of any stop hunts because we know what is happening. And then again, I mean, if you really wanted to be crazy, if you really wanted, you've got nothing else to do but day trade all day, there's another trade here in that initial low of the day, again, was retested a third time. So it was created, tested, came back and tested again. You've closed your short because all you're trying to do in Asia is trade a range, not a trend. So you close the short, you wait for confirmation on any of these candles here. You could have opened a new long position, stop loss still under the initial low of the day, take profit still back to the initial high of the day. You've got yourself another 2-to-1 risk reward. That's 3 trades in a day based off these very important levels, and they're not subjective levels. So if you've been struggling with your support and resistance levels and you feel like you're getting them right, but you still consistently get stopped out, I hope that this video has given you a little bit of an insight as to why that happens and given you some idea of maybe some better levels that might work for you that will help you to increase your win rate. Like I said, for access to all of the custom indicators that I use on this channel, consider joining a TTC membership. A membership will give you access to all of our courses, our trading tools, our community, and our live updates. And there is a link in the description of this video. Or if you just want to join the free community, then any of the exchange links down below will also get access to the free part of our Discord. Try this out. Try these levels and see if it does help to improve your trading that little bit. And if it does, be sure to leave me a comment down below and let me know.